Greetings, it is time for our monthly monetary creation update. I in fact did not do one last month, so this is after about 2 months now. And this Yardeni report is now at a different source, which is in the description box below, but is not a PDF like it used to be until a few months ago. And so over here we see the 4 major central banks of the world that comprise 85 to 90% of the entire world's money printing. And those are the US Federal Reserve, the European Central Bank, Bank of Japan, and People's Bank of China. Most are deprinting right now. They are reducing their balance sheet, except China, which is increasing it. Now, here's the thing. People who talk about the United States as printing money and therefore that will cause inflation, they don't know what they're talking about, because the United States is only a little more than 1/4 of the total world printing amount. 3/4 is not done in the United States. And printing being worldwide and technological deflation being worldwide, borderless concepts, borderless forces, both of those are, you'll see that this grand total, which is the sum of those 4 central banks, is far more relevant to any macroeconomic analysis and assessment of the impact of money printing on inflation or lack thereof. This blue line is the sum total of those 4 central banks that we just saw above. And this is at $26.5 trillion cumulative money printing since 2007. It has gone down a little bit from the peak, but is still much higher than it was pre-COVID. And all of this cumulative money printing has not caused high inflation, as we'll see in part 2 of this video, because they say it's not immediate or whatever. It's been a lot of years, and this much money printing worldwide has not caused any aberrant inflation. There are small spikes that quickly dissipate. But this is the cumulative total of world money printing of the 4 major central banks. Now, the annual growth rate of this also matters, because I contend that this has to rise at 16 to 24% a year in order to fully offset the effect of technological deflation. It's not immediate, of course, but exponential technological progress combined with the fact that technology is becoming a greater and greater percentage of the total world economy means the amount of money printing needed just to keep the ball bearings properly greased continues to rise, and I say that it has to grow within a 16 to 24% a year band. Of course, over here we are interested in this red line, because the red line includes all 4 central banks, whereas the blue line only includes the first 3 and not the People's Bank of China, so this blue line is useless. The red line being all 4, that's the growth rate that we want. And as we can see, in February of 2021, this growth rate peaked. It peaked at 43.1%, and that caused temporary inflation about a year later, as we'll see. The CPI in the United States rose 9% in 1 year and then stopped rising at nearly the same rate. That was in response to this. So that gives us some indication of the delay effect and how much money printing is needed to cause even temporary spikes of inflation. Now that these balance sheets are being unwound, this is in negative growth, and I believe that this has to rise back to 16 to 24% just to stay at this cruising control speed. This is analogous to the speed of a highway. There's a minimum speed and a maximum speed, and you can be between the minimum and maximum speed, but you cannot be below the minimum, much less stop or go in reverse, and you shouldn't go above the maximum. But this is where it should be, not down here at minus 8.1% year-over-year shrinkage and negative growth for quite some time. Now, in this final chart, we are going to look at the impact on the stock market. Traditionally, the central bank money printing, the red line over here, has correlated well with stock market increases, but now these two seem to be diverging. Even though there's a balance sheet unwinding, the stock market has risen and is continuing to make all-time highs frequently. And I did crash watch videos for quite some time when the stock market seemed to be getting wobbly because the balance sheet was being unwound, but suddenly the stock market is rallying again, and there's a number of factors that could be contributing to this, but this decoupling has happened for the first time, because otherwise this was quite well correlated. Now we shall go to my decade-long scorecard. So the economics profession assumed that all the money printing of the 2010s would naturally be reversed over the course of the 2020s, because they still cannot accept that money printing has to be permanent. The 2010s did $23 trillion of money printing, as we saw. And according to these PhD economists, the reversal of that which means minus 23 trillion printed in the 2020s decade is their prediction. Whereas I said, because this is exponential, plus 50 to plus $100 trillion would have to be printed just to keep up with exponential technological progress. Plus 50 trillion if it is done in the form of cash sent directly to people as a substitution for government spending funded by income tax, as I've described many times, but 100 trillion if it's still done in the form of bond buying, which is already saturated and breaking. This 100 trillion number presumes that bond buying is even sustainable all the way until the end of 2029, which I say it is not, because that is already causing hyper distortion in two sectors of the economy: U.S. treasuries, and therefore the extent to which the U.S. federal government can run a budget deficit, and then mortgage-backed securities, so a bubble in U.S. housing prices. If you owned a large house, you continued to make a lot of home equity gains, but if you owned a very small house or did not own any home, meaning a house on mortgage where you get leveraged gains from home price increases, then you got left behind. So for all the complaining about inequality in society, the Federal Reserve has created extreme inequality by boosting home prices, favoring people who own expensive homes the most, then favoring people who own average homes, and dead last are the people who don't have a mortgaged home. They got left behind completely. But nonetheless, what is the tally so far? And we're pretty far into this decade now. We are into March of 2024. And the grand total, as we saw, is 8.7 trillion. And this number being exponential means that even though it's 8.7 trillion in 2024, it's very much on track to get to these numbers over here, because it won't be half of this amount in the first half of the decade. It's exponential. Nonetheless, this trajectory is much closer to my prediction than the prediction of PhD economists. But PhD economists are usually wrong when they make predictions like this, because they have no penalties for being wrong at all, as I describe often on this channel. Now the question is, this much cumulative money printing, both the amount and the duration for which money printing has been going on, does that cause aberrant inflation? And for that we go to part 2 of this video. And in this month's inflation update, we are going to go back to my familiar 3-parameter matrix, where I say that all 3 of these long-term measurements have to be above 3% before I say inflation is structurally high. And inflation being structurally high is not always because of quantitative easing or money printing either, although it can contribute to that. But all 3 of these measurements have to be above 3%, not one above 3% and one below 3% and things like that. And these 3 measurements are the 10-year compound annual growth rate of the US CPI, the 10-year compound annual growth rate of the Goldman Sachs Commodity Index, and the 10-year US Treasury yield. Now I have to strike a balance between repetition for long-time viewers versus first-time viewers who need to become familiar with this matrix, and why I've chosen these 3 parameters. The Goldman Sachs Commodity Index is the most important of the 3 because commodities are A, priced worldwide, and B, are freely traded, so therefore they are exempt from the accusations of being a rigged inflation metric. Also, commodity price deflation versus inflation has a very direct correlation with human well-being or suffering, which is not quite the case with services inflation, because service price inflation is simultaneous with wage increases. Service costs for the customer going up are inseparable from a wage increase of the service provider, so it's a lot more ambiguous about whether that is good or bad overall, because the benefit to one person is simultaneous with higher prices to another person. But with commodities, cheaper is better and more expensive is worse. It's very straightforward. Also, inflation would be optimal if all 3 of these parameters were at 3%, because being too much below that is close to deflation and economic sluggishness. Deflation is bad for reasons I've explained many times on this channel. And so 3% would be optimal. It's not some big red alert type of limit. 3.1 would be slightly above the optimal limit, and so forth. So we'll go to the 10-year US Treasury yield first. This is the 10-year US Treasury yield, and it's at 4.3%. So this is higher than 3%. The higher this is, the more pressure it exerts on both the US budget deficit, because Treasury yields are higher and the interest paid out of the US federal budget becomes higher. as well as on real estate prices, because mortgage rates are governed by these treasury yields, and as these interest rates stay high, that is negative for housing prices in the US. It is quite surprising that housing prices have not come down yet, but that is because we are in tremendous stock market momentum right now. Therefore, there is somewhat of a wealth effect. That does not last forever, though. So now we go to the Goldman Sachs Commodity Index. This is the Goldman Sachs Commodity Index, and the 10-year average growth rate is minus 1.12%. It is in deflation. Commodity prices have been in deflation over the last 10 years. Oil prices are lower than 10 years ago. Gold prices are barely any higher. Natural gas prices are much lower than 10 years ago. So this is in deflation. And this, being the most important of the three measurements, indicates why I am so opposed to this inflation fear-mongering narrative. Now we go to the US CPI. This is the bls.gov website as we visit each month, and the CPI is an index like so. And as you can see, it rose quickly for about a year, but now it's back to a flatter trajectory. So the 10-year compound annual growth rate of this is taking today's value versus the value from 10 years ago and seeing what the gain was, and then taking the compound annual growth rate of this period over here. And I'll have a table shortly that shows you that. But as we see over here, this 1 month inflation rate recognizes that brief blip we had, but it has subsequently been flat since that time. The 2 month inflation rate indicates the same thing. The 3 month inflation rate, also the same thing. 6 month inflation rate, we've also gotten back down to a low inflation status quo. And the 1 year inflation rate, it hasn't quite got below 3% yet, but it's definitely past this one-time bump. And now we go to a table to represent this data in another way. This table is quite convenient in looking at that bls.gov website in a cleaner representation all in one screen. The 1 year inflation rate is 3.2%, but the 10-year compound annual growth rate is still just 2.8%. So even though short periods have certain volatility, this 10-year compound annual growth rate takes a lot to move up and a lot to move down as well. So it is not a cherry-picked duration, despite what some inflation-seeking people feel. Who are inflation-seeking people? Those who desperately want to feel like victims and ignore all data to say that inflation is high. And I have exposed the emptiness of their arguments many times on this channel. I also indicate what CPI inflation has been since the beginning of the 21st century. So since January 1st, 2001, the average annual inflation rate in the US has been 2.5%. Not any more than that. And that blip that we saw is now receding into this 3-year and 5-year window. Even the 2-year inflation rate is 3.9% because most of that blip is more than 2 years ago, and it resides in these 3-year and 5-year windows. But for the purposes of my 3-parameter matrix, this 2.8% 10-year compound annual growth rate is what we're interested in. So now we go back to that matrix. So we saw all three, the 10-year compound annual growth rate of the US CPI, the 10-year compound annual growth rate of the Goldman Sachs Commodity Index, and the 10-year US Treasury yield. And today, on March 15th, 2024, we see 2.8% for the US CPI, so still below 3%, although not by much. Minus 1.12% for the Goldman Sachs Commodity Index. This is in deflation. It's very far from 3%. I contend it can never get to 3% again, and I'm going to modify this measurement to show an even longer term trend line of commodities. And then the 10-year US Treasury yield is 4.3%. This is the only one out of the three that is above 3%, but this being higher is also very bearish for both housing and for US government spending, which both are contributors to CPI inflation. So this staying high too long could pressure these two into going lower as well. So inflation is not high, and I don't care what anybody says because I am taking a very data-driven approach that is not rigged to give a certain conclusion output. All of the critics who say that these methodologies are not the correct way to measure inflation tend to have no empirical rigor in their measurement. They debate by anecdote, or they just assert that the indices are rigged because it's easier for them to feel like victims if they believe that the indices are rigged, but they're unable to prove that they are. Now we go to another measurement that has a lot to do with inflation that people cite as something that will cause inflation to be high, and that is velocity of money. This is a chart from the Federal Reserve regarding velocity of M2. In other words, how quickly money is circulating relative to the money supply. During COVID-19, the money supply increased tremendously, as we know from all the quantitative easing. So the velocity of money fell because money supply was the denominator of that equation. And a lot of people who said that we are about to have hyperinflation when this velocity of money gets back to what it was pre-COVID, they could have been right if it shot back really fast, and that would have been a brief flurry of inflation that died off pretty quickly. But as it took time to get to higher velocity of money, almost back up to what it was pre-COVID, even this factor has now been eliminated as something that could cause high inflation. Velocity of money has been rising since the beginning of 2022, so for 2 years it has been going higher again. It's back up to this point over here as well, and therefore, like I said, this factor can no longer be applicable as one of the things that even could cause high inflation again. So all the people desperate to see higher inflation have lost yet another big thing they were hoping for: velocity of money springing back to what it was pre-COVID. Now finally, we'll go to some sector level data. This is from CNBC, and while I say that the index should always be what people look at for inflation, everyone who wants to disagree with that tends to throw forth anecdotes that are not even categories of goods, but a single branded good like Doritos or Big Macs or something like that. Always processed food and always something likely to cause inflammation. And I have to wonder if there's some connection there. Their misplaced fears of inflation should in fact be fears of inflammation, given how bad their diets are. But nonetheless, as we see here, look at the things that have fallen in price. Essentials like eggs. The extent to which people think eggs have skyrocketed in price relative to the reality of eggs being in deflation is really quite funny, and I have videos about that on this channel, such as in this tag in the upper right hand corner over here. Many people have just lost their minds on the subject of inflation. Other things that keep falling in price are like apples, lettuce, ham, fish and seafood. All of it's falling. Energy, the whole sector is in deflation, minus 1.9% in terms of what a consumer would spend on energy. Gas service is minus 8.8%. Gasoline is minus 4.2%. Fuel oil minus 5.4%. And other items that are also very important for consumers have been falling in price. Health insurance minus 20%. That is huge. Health insurance is a big concern for a lot of people, but at least it has been going down in price. So if you want to get into sector level granularity and debate via anecdote, then I have all these anecdotes to throw back at you. If you are hell-bent on imagining that inflation is high so that you can feel like a whiny victim, unfortunately, a lot of conservatism and libertarianism in the US has become very whiny and victim-oriented, in stark contrast to what it was 40 years ago when it was ambitious, optimistic, and was high on personal responsibility, as opposed to seeing oneself as a victim, even to the extent of making something up, such as inflation being much higher than it is. I don't want viewers of this channel to fall into that type of victim mentality mindset because the data says otherwise. Now, if you like this type of content, I encourage you to subscribe to this channel, and thank you very much for watching.